Covering the latest disaster in the Dow Jones Industrial Average, in which the venerable index lost 890 points over the course of 2 days, mainstream business analysts are quick to discount the so-called Death Cross indicator that seemingly predicted the present calamity only a week earlier. Several Wall Street pundits have noted that the last 2 times the Death Cross flashed in the charts, back in August of 2011 and July 2010, the Dow Jones on both occasions managed a quick recovery. However, the current market dynamics, based on technical factors like rate of decline and fundamental arguments such as historical context, suggest that most financial experts are ignoring the ghosts of 1937. 7 years after the crash of 1929, Americans looked forward to a time of renewed optimism, a not so unreasonable idea at the time. The unemployment rate dropped from a ridiculous 21% to a more palatable 14.3%. The Golden Gate Bridge opened, giving Americans pride in their engineering prowess. After the Dow dropped to a sickening 41 points in 1932, the opening day of trading in 1937 closed at a respectable 178 points, more than quadrupling the Great Depression bottom. It was also a time of social transition, with the most powerful example being Amelia Earhart's attempt at circumnavigating the world. We see similar overtures today. More than 6 years after the 2008 global financial crisis, the unemployment rate on paper has been driven to multi-year lows. The Dow on a nominal basis has made all-time record highs, and controversial social issues such as gay marriage and women in combat have routinely made headlines. But in 1937, the bullishness, at least from a financial perspective, was premature. After a death cross flashed in the Dow on September 15th, the markets tumbled 2 days later and combined for a steep drop of negative 3.25% on the 8th and 9th day following the harbinger. The markets bounced back the next week, starting with a 3% move on Monday. However, as traders absorbed incoming data, it became readily apparent that the markets could not hold up forever. In the weeks ahead, the bears took control, with sell orders being yelled into the caverns of Wall Street. Exactly 180 days after the initial death cross, the market was still deep in the red, shedding 39 points or 24% of valuation. Similar to the present crash in the Dow, the biggest hit occurred towards the end of the week. Also, there were 5 death crosses that flashed after Black Tuesday, with none of them leading to losses within 30 days of the signal. Thus, there was confidence that the markets could weather the storm. Those who did jump in ignored critical international factors that would ultimately culminate with the Second World War. Of course, the future is not certain and history is not guaranteed to repeat. Nevertheless, human psychology has dictated a path of repetition, and the ghosts of 1937 warn us not to ignore their hard-earned lessons.